What the Federal Reserve is and why it matters. The Federal Reserve, often called the Fed, is the central bank of the United States. It controls how money moves in the economy. The Fed does not make laws, but its decisions affect everyone. It affects workers, businesses, investors, and even people outside the United States. When the Fed makes a change, global markets often react very fast. The main job of the Federal Reserve is to keep prices stable and the economy healthy. To do this, the Fed controls interest rates. Interest rates decide how expensive it is to borrow money. When interest rates are low, people and businesses borrow more money. When interest rates are high, borrowing becomes harder and more expensive. The Fed also controls how much money flows in the system. When the economy is weak, the Fed can add more money to help growth. When inflation is high, the Fed can slow the economy by making money harder to get. In recent years, inflation became a big problem. Prices of food, rent, fuel, and daily goods increased very fast. To fight this problem, the Federal Reserve raised interest rates many times. This made loans more expensive. It slowed spending and slowed business growth. These decisions were painful but necessary. The Fed wanted to cool down inflation and bring prices back under control. While this helped inflation, it also caused fear in the stock market. Many investors became worried. Stock prices went down, and growth slowed. Understanding the Fed is important because markets move based on what the Fed says and does. Even small changes in Fed language can move markets. That is why investors watch every Fed meeting closely. What the Fed did from 2022 to 2024, from 2022 to 2024. The Federal Reserve followed a very strict policy. Inflation was rising too fast, so the Fed took strong action. It raised interest rates again and again. This was one of the fastest rate increases in history. Because of higher interest rates, borrowing money became expensive. Home loans, car loans, and business loans all cost more. Many people stopped buying homes. Businesses slowed down hiring. Some companies even reduced workers. At the same time, the Fed stopped adding extra money into the system. In earlier years, the Fed printed large amounts of money to support the economy. This helped during crises, but it also added to inflation. So the Fed decided to reverse this policy. Stock markets reacted negatively at first. Investors were scared of slower growth and lower profits. Technology stocks and growth stocks were hit the hardest. Many people moved their money into cash or safe investments. However, the Fed always said that these actions were temporary. The goal was not to destroy growth, but to control inflation first. The Fed believed that once inflation was under control, it could support the economy again. By late 2024, inflation started to slow. Prices were still high, but they were not rising as fast as before. This was a sign that the Fed's policy was working. Markets began to pay attention to what the Fed would do next. This period was painful, but it set the foundation for the future. Strong medicine was used to fix a serious problem. Now the economy is closer to balance. What is changing now, and why markets care now the situation is changing? Inflation is no longer rising at the same speed. Economic growth is slowing, and some areas show weakness. Because of this, the Fed is no longer raising rates aggressively. The Fed has started to pause. This means it is waiting and watching. It wants to see how the economy reacts before making the next move. This pause is very important for markets. Markets do not wait for official actions. Markets move on expectations. When investors believe rate cuts are coming in the future, they start buying assets early. The Fed has also changed its tone. Instead of talking only about fighting inflation, it is now talking about balance. It is signaling that it will support growth if inflation stays under control. This shift is called a move from tight policy to easier policy. Historically, this shift is very positive for financial markets. It usually leads to rising stock prices over time. Investors believe that the worst part is already behind us. Fear is slowly turning into cautious hope. This is why markets are watching 2025 and 2026 very closely. The Fed may not cut rates immediately, but its direction matters more than timing. Direction tells investors where the economy is heading. This change in policy mindset is the first step toward a potential market recovery and future rally. Why 2026 could be a strong market. Many analysts believe 2026 could be a strong year for markets. The reason is simple. By that time, interest rates are expected to be lower. Lower rates mean cheaper money. When money is cheaper, businesses can borrow and invest more easily. They can expand, hire workers, and grow profits. This usually helps stock prices rise. Lower interest rates also make stocks more attractive than cash or bonds. Investors move money into stocks, searching for higher returns historically. Markets perform very well after the Fed finishes tightening and starts easing. This pattern has repeated many times in the past. Technology companies and growth sectors usually benefit the most. These companies rely on borrowing and future growth. Lower rates support their business models. Investor confidence also improves. People feel more comfortable taking risks when the economy feels stable. This creates positive momentum in markets. However, rallies do not start suddenly. They build slowly. Smart investors often position themselves early, before the full rally begins. That is why many people believe the foundation for 2026 is being built right now. The hard work has already been done by the Fed. Final summary and key takeaway to summarize everything clearly. The Federal Reserve tightened policy to stop inflation. This caused pain in markets and slowed growth. But inflation is now easing. The Fed is no longer raising rates aggressively. It is preparing for a more supportive policy in the future. Markets are reacting to this shift. By 2026, interest rates are likely to be lower. Money may flow more freely. Businesses and investors could benefit from this environment. This does not mean markets will move up every day. There will still be ups and downs. But the long-term direction looks more positive. The most important lesson is that markets move ahead of news. By the time rate cuts happen, markets may already be higher. Understanding the Fed helps investors make better decisions. It helps them prepare instead of reacting late. The stage for 2026 is being set now. Those who learn and prepare early may benefit the most. Please subscribe me and have a nice day. Thank you.